Are you looking for ways to build wealth fast and retire early? Living off dividends could be your best bet. Many investors do not know that they can live off dividends and enjoy their youthful years as well. Generally, many believe they either sell off their investment or wait for decades before earning something substantial enough through dividends. No, with the right strategy and discipline, you can enjoy the returns on your investments while you spend time doing what you love. Wondering how to go about this? Ensure you watch this video until the end. Dividends refer to a reward that a company gives to its shareholders. It can be issued in various forms such as cash payments, stocks, or other forms. When a company earns a profit, it can reinvest that money with the hope of growth or distribute the profit to its shareholders in the form of a dividend payment. It could be monthly, quarterly, or annually. Of course, if you are living off dividends, this payout becomes your primary source of income that finances your living expenses, just like the way your income from a regular job would. However, in this case, you aren't working for anyone. You only sit back to enjoy the returns from your investment. This sounds great, right? Do not overlook the fact that living off dividends is only a source of revenue. Even if it doesn't cover all of your expenses, it could go a long way. For example, generating 1 or 2,000 of monthly cash flow from your investment may not cover all of your expenses, but can enhance your early retirement goal. Several types of investments offer the possibility of dividend payment. What is right for you depends on many factors, such as how much you would need to maintain your standard of living, your risk tolerance, your capital, and so on. Here are the most common choices you can consider. Covered call exchange-traded funds. Exchange-traded funds, or ETFs, are funds that trade on exchanges tracking a specific index. ETFs include dividend-paying stocks, and those dividends are passed on to investors. When you invest in an ETF, you get a bundle of assets you can buy and sell during market hours, potentially lowering your risk of exposure while helping to diversify your portfolio. They are generally bought and sold like a common stock on any exchange market. A covered call exchange-traded fund purchases a selection of stocks and writes call options on them to boost investors' yield. It is a very popular way to boost your earnings. These are ETFs that produce income using a covered call strategy. What does this mean? A call option is a contract that grants the holder the rights but not the duty to purchase a specific stock or ETF at a specific price within a specific time frame. It offers investors the benefits of writing call options on stocks without having to participate in the option market directly, and they have a higher yield than traditional dividend stocks. If you are looking for an affordable, tax-efficient way to access a broad range of asset classes, consider investing in ETFs. Why? Diversification. ETFs let you access a diverse mix of asset classes, including domestic and international stocks, bonds, and commodities. They typically have lower operating expense ratios, or OERs, than actively managed mutual funds. They combine the trading versatility of individual securities with the diversified qualities of mutual funds to meet a variety of investment needs, and they are widely considered to be more tax efficient than actively managed mutual funds for several reasons. Real estate investment trusts, or REITs. REITs allow you to invest in real estate without the need to own or manage the property. Investing in REITs is also a great way to earn dividend payout. They allow individuals to invest in large-scale, income-producing properties. A REIT is a company that owns and typically operates income-producing real estate or related assets. These may include office buildings, shopping malls, apartments, hotels, resorts, self-storaging facilities, warehouses, and mortgages or loans. Unlike other real estate companies, a REIT does not develop real estate property to resell them. Instead, a REIT buys and develops properties primarily to operate them as part of its own investment portfolio. REIT types include equity REITs, mortgage REITs, and hybrid REITs. Most of them are equity REITs, which own and manage income-producing real estate. Revenues are generated primarily through rents and not by reselling the properties. Mortgage REITs lend money to real estate owners and operators either directly through mortgages and loans or indirectly through acquiring mortgage-backed securities. Their earnings are generated primarily by the net interest margin, the spread between the interest they earn on mortgage loans and the cost of funding these loans. This model makes them potentially sensitive to interest rate increases. And hybrid REITs are the investment strategies of both equity and mortgage REITs. Most of the REITs are registered with the Securities and Exchange Commission and are publicly traded on stock exchange. Others may be registered with the SEC, but they're not publicly traded. This is one of the most important distinctions about the various REITs. Before investing, you must understand if it's publicly traded or not and how this can affect your earnings. Dividend stocks. A dividend stock is a publicly traded company that regularly shares profit with shareholders through dividends or additional shares. The most popular option for dividend investors is an individual company stock. These are big, well-established, prominent companies with track records of success, profitability, and dividend growth. As long as your expenses remain below the amount you earn in stock dividends, you can preserve the capital of your investment. Though the cost of living may increase, and with inflation on the rise, thankfully, many companies regularly increase the dividends payout, which often exceeds the inflation rate. If you are investing in the right companies, the dividend income growth should more than cover inflation in the long run. Regardless of your life stage, dividend stocks can greatly supplement your income and improve your portfolio's growth potential. Plus, with the long-term compounding effect, you could become a millionaire in a few years. However, you need to ensure to research the company's overall finance health, not just their dividend rates before investing. Some high-yield dividend stocks include Devon Energy with an 8.4% yield, Verizon Communications with a 6.6%, and Philip Morris International with a 5% yield. How much do you need in your portfolio to live off the dividends? The answer to these questions depends on your lifestyle, how much you spend each year, and what dividend yield your investment produces. For example, if you need $40,000 per year for expenses and your investments produce an average yield of 4%, you will need to have $1 million invested to earn about $40,000 annually. To generate a substantial amount that provides a comfortable lifestyle, you would need to build a portfolio at least $2 million. That sounds like a huge sum of money, but if you are intentional about it and taking a step forward at a time, you will achieve this. Starting early is the best way to get ahead. With the right skills and proper understanding of the market, there are numerous opportunities to earn a decent monthly payout. Investing in dividends has several benefits, which include growth and expansion of profits. One of the primary benefits of investing in dividend-paying companies is that your dividends tend to grow steadily over time. Besides, dividend stocks offer at least a partial return on investment that is guaranteed. It is rare for dividend-paying companies to suddenly stop due to any reason. Instead, most of these companies tend to increase their payouts. Reduced risk and volatility. Dividend investing is a major strategy for reducing overall portfolio risk and volatility. In a diversified portfolio, dividend payments could compensate from any losses incurred from a decline in other stock investments. Studies have historically shown that dividend-paying stocks outperform non-dividend-paying stocks during bear market periods. Dividends offer tax advantages. Do you know that dividends are taxed at substantially lower rates than ordinary income? As regards taxes, dividends are often treated differently. So if you are looking for an efficient means to generate income and pay less taxes, then this is your best option. They're a reliable source of passive income, and dividends preserve purchasing power of capital. You do not accumulate dividends that can sustain you through retirement overnight. It is a step-by-step process that requires consistency. The decision to live off dividends needs you to be deliberate about each step you take towards achieving your goal, and when you finally do, you will see that the efforts were not wasted. Thank you for watching. Do not forget to like this video, leave a comment and subscribe. See you in the next video.